President Donald Trump just announced a new 50-year mortgage. If the American dream isn't already dead, it's on life support. When the government and the banks stretch debt half a century just to keep housing affordable, what does that say about the health of the dollar itself? Meanwhile, a federally chartered US bank just became the first in history to offer Bitcoin custody and trading directly to its customers. Plus, Lyn Alden lays out evidence that we're not entering a bear market at all, but a structural expansion more like the rise of the Mag 7 than the boom and bust cycles of Bitcoin's past. Stay tuned, because between government stretching time to survive and banks turning to Bitcoin to adapt, this moment is bigger than most people realize. Welcome to No Second Best, the show where conviction meets reality and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. A 50-year mortgage might sound like innovation to some, but it's really just desperation. It's the logical endgame of a fiat system that can't let prices fall, so it stretches time instead. If you can't afford that house, instead of lowering prices, they just extend the leash. And here's the uncomfortable truth. You never really own it in the first place. Property taxes are rent to the state. Interest payments are rent to the bank. Miss either one, and you'll find out who actually holds the deed. So when the president proudly announced a half-century mortgage, he's not making homes affordable. He's making debt eternal. And this is the world Bitcoin was built to escape. A system where ownership is synthetic and freedom is leased one payment at a time. And here's the irony. While government policy keeps doubling down on more debt, some parts of the system are finally waking up to what real ownership looks like. Because within the same week that politicians are trying to make the dollar last longer, a federally chartered bank just took its first step into a world beyond it. This morning, CNBC broke a story that didn't get nearly enough attention. SoFi Bank, a federally chartered national bank in the United States, just launched the ability for its customers to buy, sell, and custody Bitcoin directly inside their bank accounts.
New this morning, we got the guy at the desk. SoFi launching crypto trading on its platform. Joining us right now, first on CNBC, is SoFi CEO Anthony Noto in town. It's nice to see you, sir, in person.
Good to see you as well.
Okay, so what's going on here? This is a big deal.
Yeah, this morning,
a very big deal for you.
It is a very big deal. It's a big day and a big milestone. Reverses the course of time.
It does.
We've wanted to be a one-stop shop for all your financial services needs, and one of the holes we've had for the last 2 years was in cryptocurrency, the ability to buy, sell, and hold crypto. We were not allowed to do that as a bank. It was not permissible. But in March of this year, the OCC came out with an interpretive letter that it's now permissible for banks like SoFi to offer cryptocurrencies. So this morning we're launching, as the only national bank, the first and only national bank, the opportunity to buy, sell, and hold cryptocurrencies like Bitcoin, Ethereum, and Solana.
And what's the difference between going through you and going through Coinbase or going through Robinhood or somebody else?
Yeah, there's a couple of really big differences. First, we're a nationally chartered bank, which means we have the infrastructure, the processes, the financial conditions that provides the safeguards that a consumer would expect from a bank, which is going to allow us to scale responsibly. The second thing is, because we are a one-stop shop, you can do all your banking, checking, and savings at SoFi, your borrowing, and your investing, and now crypto. And one of the unique things about that is when you come to SoFi and fund your crypto investments, you'll fund them in a SoFi checking and savings account. That checking and savings account's deposits earn interest.
Say that again. You're going to fund it with crypto?
You're going to fund
your checking account.
You're going to fund your checking account with cash.
Okay.
And then when you buy Bitcoin or Solana or Ethereum, the money will come straight out of your checking and savings account. So when you're not putting cash to work, it's not sitting in an account that earns no interest, and it's not sitting in an account that's not insured. So the money will sit in an FDIC insured account. Up to $2 million is what we offer. And when you buy, it will instantly withdraw from that account and send it to the marketplace.
This is a regulated bank, FDIC insured, integrated with checking and savings, and now integrated with Bitcoin. We're watching the line blur between the old system and the new one, not in theory, but in practice. Because once one bank offers Bitcoin, the rest will have to follow, not because they believe in it, but because customers demand it. This is yet another example of Bitcoin game theory playing out, which will always end in the best form of money winning. And SoFi is doing this brilliantly against one of the strangest and strongest backdrops in years. There's now a 95% chance the US government reopens by the end of this week, according to Polymarket. But here's the interesting part. After the 2018 and 2019 government shutdowns, Bitcoin surged 96% and 157% in the following months. Meanwhile, Bitcoin just bounced off of its 50-week moving average and closed above it, the same point that marked the start of every major rally since early 2023. Even JP Morgan, of all places, just raised their target to $170,000 within the next year, calling Bitcoin, quote, undervalued versus gold. So, bears, are we sure this is weakness? Or is this the quiet stretch before the next wave begins? Let's look at what legendary investment analyst Lyn Alden has to say about where we are in Bitcoin right now from the latest episode of Swan Signal Live.
So I don't think we're in like a full-on bear market. I think we're obviously in a weak portion of the cycle, and Bitcoin has been roughly flat for 12 months now. It's had a lack of catalyst. It's one of those things where it gets ahead of itself for a period of time and then corrects, and some of those corrections go on for 6+ months. This one basically went on for 12 months, even though there were new highs along the way. I've been in the camp of always being a bearish bull, which is I try to avoid price targets, more focused on direction because you can't necessarily predict like illiquid moves and kind of euphoric periods or kind of lack thereof. But when I do get cornered into giving a price target, I think one of my main ones was 150K for this year. So it looks like we probably not going to touch that, but like John said, we still have 2 months to go. So we'll see what happens. So that's we hit 125 or change. I had a similar thing last cycle where at first my target was a trillion market cap, which was somewhere in the ballpark of 50K. We touched that. And then I gave a target of, I think we'll hit 100K. That was still lower at the time than many of the bulls. We ended up not reaching that. We ended up only getting 69. So far, we're in a similar thing where we hit initial bullish targets, new highs and all that, but then stagnate a little bit. I generally wouldn't look too much into this whole kind of 4-year cycle aspect. As the halvings continue, the new supply is a much smaller component of the total supply and demand out there. It's more about what price will unlock coins from existing holders, either because they want to sell into bullishness or because they're selling into weakness. They're afraid of their position, either one. That's the type of thing that can, really affect price more so than what is the rate of new coins hitting the market at this point. In addition, prior cycles, because it was a much smaller illiquid market and with kind of in general on average less sophisticated kind of participants, not necessarily in terms of like intelligence or anything like that, but in terms of hedging, in terms of how they tend to rebalance and stuff like that. We had more non-financial people involved, basically people that are sophisticated in other areas, not in terms of like sort of portfolio management. It didn't really follow normal rules of assets. Whereas now that it's held by those who tend to hold other assets, they tend to treat it like they do other assets, which often results in rebalancing and things like that.
Yeah.
And so in prior cycles, like the market cap would get way ahead of the on-chain cost basis. And so it like some of that price spike would be ephemeral because it's like it didn't really reach that price on a sustained basis. It was just like a small number of coins would then, when you extrapolate over the whole market cap, say this is the current price, but it wasn't like a price that was kind of a very liquid price. And so I think we're past those kind of periods of just massive disconnects. We still have the on-chain average cost basis inching up at this phase. So I generally think that while it's been weaker than expected, I generally view that the cycle is going to go on longer than expected because I think we're driven by other things ranging from regulatory actions, ranging from liquidity, ranging from all sorts of other things, fiscal, economic stuff, and very much less to a nearly negligible degree, the supply halving cycle.
Lyn's right. This doesn't feel like 2021, and that's exactly the point. The halving-driven fireworks are fading, but in their place comes something far more durable. Bitcoin is being priced less like a speculative asset and more like a reserve asset, shaped by liquidity, fiscal deficits, and real demand from the broader financial system. And when an asset crosses that line from narratives to necessity, its behavior changes. It stops trading like a small cap bet and starts moving like an index. Lyn points out that we've seen this before. It's a similar transition that turned the tech bubble into the mega cap era.
Yeah, I think an example to be familiar with is the Mag 7 stocks, basically these really mega cap US tech stocks over the past 15 years. For a lot of them, if you ask what cycle were they on, not a
Yeah.
particularly a specific cycle, and the booms and busts were muted because they started from a larger base than Bitcoin was 15 years ago. And they've gotten some of them to a larger market cap than Bitcoin is now. And they've traded in traditional markets. And if you ask people before, the idea of $1 trillion company was an extreme thing. And now companies that have been over 4 trillion. I think Nvidia might have touched 5, I'm not sure, but several have touched 4 at this point, and more have touched kind of 2 and 3. And so a lot of these companies over the course of 5, 10, 15 years reached heights that most people did not expect them to. And they just kept, every time they would say, okay, this price to earnings multiple is a little bit high, or this is concentrated. For a period of time, it might cool off for 6 months or 12 months. And then it just has another rip higher because it's fundamentally being adopted, whatever kind of product or service they had. And I think Bitcoin's kind of in that phase now where there are some bears that are saying 2 trillion market cap, that's enough. How could it possibly go higher than that? It's magic internet money. How could it go higher? Kind of like how could a phone company like Apple, how could that get as high as it is, or how could an operating system company like Microsoft get as big as it does? And I think basically over the next 5-10 years, it's going to behave like that, where it surprises bears to the upside, where it just gets bigger and goes on for longer than they think. But it doesn't mean that basically bulls are going to be entitled to 5x multiple gains in a typical 12-month period. It's not on that kind of easy 4-year clock as it was for a period of time. And I think even the 4-year cycle, and I've done research on this, the last couple cycles, it was a blend of the halving cycle and the liquidity cycle. And so as basically we have the importance of one declining to the point where it's almost negligible now, and then those other factors gradually increasing in prominence as they affect Bitcoin's price.
Just think about what Lyn's saying here. Apple, Microsoft, Amazon, and Nvidia, eventually they stopped running on hype cycles once they became foundational. Their corrections got smaller, their timelines stretched, but their trajectory stayed up and to the right. And that's where Bitcoin's heading. The volatility's compressing, but the market depth keeps growing. The 4-year rhythm is giving way to structural adoption. This is looking less and less like a blow-off top and more like a consolidation before the next expansion. This next phase is all about maturity. If Bitcoin is shifting from speculation to reserve status, then how we manage it has to mature as well. And that's where Swan Private comes in. It's not just a brokerage, it's a full stack Bitcoin wealth platform built for families, businesses, and institutions who think in decades, not quarters. Swan Private helps clients integrate Bitcoin into a longer-term plan, from tax-efficient accumulation and tax loss harvesting strategies to self-directed IRAs that hold real Bitcoin, to upgrading custody with secure multi-sig vaults. The Swan Private team also works with families on inheritance planning, because if you're building generational wealth, you need a framework to make sure it actually transfers. At Swan Private, we don't just help you buy Bitcoin, we help you steward it, with the same conviction and discipline that built every lasting family fortune in history. Learn more at swan.com/no-second-best. And that's exactly the mindset this moment demands, because the macro winds are shifting again. While individuals and families are learning how to build lasting wealth, the world's monetary foundation is quietly being rebuilt as well. Balance sheets are flattening before the next expansion. Liquidity is turning back on. And the same forces that once inflated bubbles are now underwriting a very different kind of growth. And that's what Lyn Alden explains next, why the structural trends that matter most are still pointing straight to Bitcoin.
And on that second group of factors, Lynn, would you agree that these kind of more macro liquidity-driven factors, things like CPI inflation, Fed interest rates, central bank balance sheets, M2 money supply, U.S. federal spending as a percentage of GDP, do you think those are some of the core macro factors that are going to be affecting Bitcoin? And then if so, what's your forecast for whether those particular items are going to be generally supportive of Bitcoin's price or the opposite?
Yeah, so I do think factors are the key drivers. Basically, the type of things that drive a lot of high quality assets up or put kind of near-term pressure on a lot of high quality assets. Various things related to the hardness of money, liquidity, that kind of thing, a lot of the factors you cited. And then, as you point out, unlike 2022, we don't see a major contraction in a lot of these things. Instead, some of them take a pause for a period of time, others are still accelerating. And so I expect the numbers to be pretty good in 2026 and 2027. I think we're ending the period of Fed balance sheet contraction. We're entering maybe a flat period for a period of time, and then most likely expansion for a while. I would say not at the rate that some people think. My general view is that we're not going to get some massive QE anytime soon, but that instead we're going to return to a period of kind of structural balance sheet increases at a moderate pace. And that over the kind of longer term is beneficial for a lot of assets, including Bitcoin. And it's more the persistence of it, the length of it.
What Lyn's describing here lines up with what macro analysts like Jordi Visser have been warning about: the return of structural money growth, balance sheets flattening before expansion again, fiscal spending locked in and AI driving productivity in ways that require more liquidity, not less. It's the AI Bitcoin intersection, the digital economy absorbing the old one. And Bitcoin is sitting right in the middle, serving as both asset and anchor. And that's why the bear market narrative misses the forest for the trees. You can have sell-offs, you can have rotations, but this structure isn't breaking. Not while every indicator of liquidity is turning up, and not while demand for hard collateral is rising across the board. The world isn't slowing down. Liquidity, AI, and adoption are all still accelerating. This isn't a hollow bubble. It's an expansion. The fiat system is stretching itself thinner with 50-year mortgages, while Bitcoin keeps doing the opposite, compressing time, clarifying value, and settling ownership roughly every 10 minutes. So no, I definitely don't think this is the end of the cycle. I think it's the start of a generational repricing. But I'm curious what you think. Does this new phase end in exhaustion or in escape velocity? Is Bitcoin maturing faster than the fiat system is disintegrating? Let me know what you think in the comments below. Like this video if you found it valuable, share it with a friend, and don't forget to subscribe to the Swan Bitcoin channel to keep the signal strong. Thanks for watching, and remember, there is no second best money.